you so much for joining. Today I would like to briefly and easily introduce interest rate risk for fixed income instruments or investments. When we talk about fixed income, we basically mean debt, because as you know, compared to equity, debt has a contractual agreement underlying. You receive, as an investor, you receive steady coupon payments for your debt instrument, so we call it fixed income. You are not entitled to any additional profit the company makes, or if the company does really well, you're not entitled, you don't have voting rights, you have no access to the residual value of the company, you're no equity investor. That's why when we call fixed income, because the payment and the cash flow that you receive is kind of fixed. Yeah, so fixed income / debt investments. Let's assume you are an investor and you have bought one piece of paper. As mentioned earlier, it's not in paper form, but one debt instrument, one fixed income instrument. You have paid, let's assume you have paid, present value, you have paid 100. So you as an investor, you bought an instrument, debt instrument, for $100. What does it mean? It means you are entitled to 5% coupon every year, and you are entitled after 10 years to receive the face value of the bond, debt instrument bond, back 100. So you receive 5% coupon payment, means basically $5 annually, 5% times face value. So what is your return? In general, what are the items? One is coupon payments, your face value that you get the 100 back, and then it's reinvestment of coupon payments. Yes, you get $5 every year, but you can earn money if you invest the $5 somewhere else, other instruments. So you have a return on reinvestment. And if you sell your bond, let's say you bought your bond for present value 100, if due to interest rate environment, if there are changes and your price increases, selling fixed income investment. Yeah, so these are the 4 options or the 4 return items that you have as an investor. What are the risks? There are 2 types of risks that make up interest rate risks. One is price risk, and the second one is reinvestment risk. What does it mean? That means today you bought a bond. These are the bond terms. You paid $100, that's what you get. What can happen in the future? 2 things can happen. A, interest increase. Yeah, the interest rate environment increases. Or B, interest rates decrease. Rates increase or interest rates decrease. This is what can happen in the future. Let's think about interest rates increase. If you're an investor and you bought the fixed income instrument today and the interest rate increase, there are 2 things that will happen. First, you would say, shit, I bought this instrument, I get only 5% coupon. All the new bonds that are issued, because the interest rate environment has become interest rates has increased, this would potentially lead to the new bonds offer a coupon 6%, 7%. So you are like, the terms I have here are not so good. All the new bonds will potentially offer a higher coupon. This means if this is the case, then your bond is less valuable because all the new bonds, they will provide you with a coupon of 6%, 7%, 8%. Your coupon rate is 5%. So your bond is actually not that good, which means it loses value, which means your present value is potentially lower than what you initially bought for it. So you lose a bit of money because if you want to sell your bond, you won't get the present value you bought for it today because the interest rate environment has changed. So your bond, because of the 5%, which is fixed due to the contract, will lead to a less competitive bond. However, what would happen is once you receive $5 annually, you can actually reinvest those $5 because they belong to you. You will receive them in your bank account and you can reinvest those $5 at a higher price. So what would happen is your reinvestment is actually positive. So if interest rates increase, it is good for your reinvestments because you can reinvest your yearly coupon at a higher rate. But your bond price, your present value, will decrease because your bond is less valuable because all the new bonds are issued at a higher coupon rate. If your interest rates decrease, then your reinvestments are lower because if the new interest rate environment sits at 4%, then what do you do with the $5? You can't reinvest on a lucrative terms. However, if all the new bonds are issued at 4%, at 3%, your bond is at 5% higher, then your present value is potentially higher than what you paid for. Yeah. So number one belongs to A, and the second one belongs to B. If you look at both short term, long term, the longer you hold the bond, the longer the maturity, the more impact the reinvestment component has. The shorter you hold a bond, the bigger the price risk component. Yeah, quite easy to understand. If you hold a bond for 100, 200 years, you can reinvest every single year. Yes, your price decreases, but the opportunity you have over 100, 200 years, 50 years, I'm just exaggerating, will overcompensate. Yeah, there's one, I will discuss this later. There is a timing how long you should hold a bond so that the short-term price risk equals your long-term reinvestment risk. And as you can see, they always go in the opposite direction. Here, this is positive. Your price risk is negative. Here, reinvestment risk is negative. And here, this is positive. So they always go in the opposite direction. And there is a holding period where if you hold the bond 7, 8, 9, 10 years, then your short-term price risk equals your long-term reinvestment risk. And this is called Macaulay duration, which you can calculate, which I will discuss in another video. Yeah, so to recap, interest rate risk for fixed income investments, price risk, short-term, reinvestment risk, longer term. There are always two effects. If interest rates change, one effect has to do with the reinvestment opportunity, and the other risk is that your price of the bond will increase or decrease depending on whether your interest rates increase or decrease. I hope you found this useful. Thank you so much for listening. Bye bye.